Hey there, everybody. Good morning. Lee Lowell here, smartoptionseller.com. How's everyone doing? Today is Saturday, August 29th, 2020. Welcome to another edition of your Saturday Synopsis. And this is where we take a look at the charts, the market, see what happened over the previous week, and give some ideas what maybe going forward for the next week. We also talk about options trading here. We give some free options information. And today we will be talking about selling cash secured put options versus selling naked put options and how they differ. What's the difference? How's the margin used? Do you need margin? I get questions about that all the time. How does the money work when you sell either one of those methods? So we will be talking about that today. So let's get to the charts and see what happened over the previous week. We open up to look at the SPY, which is the exchange traded fund for the S&P 500. If you've been watching my Saturday Synopsis videos, we always talk about the SPY first because it's the basic general broad indication of the market as a whole. This past week, we had the final blast off through the resistance and have made, without a doubt, all-time new highs in the S&P 500. Just last week, we didn't have this. We were bumping up against this double top here. Last week, we talked about the double top. Got the major top here back in February before the coronavirus. And then we were bumping up against that just last week. And last Saturday, I talked about it's either going to blast through it or it's going to meander and just kind of trade sideways for a while because we wanted to digest the move all the way back up to all-time new highs. The market didn't give two you-know-whats about that and decided we're just going to blast right through it. So each day this week, Monday, Tuesday, Wednesday, Thursday, Friday, new highs every single day, just blasted through the 339, 340 resistance level with no problems whatsoever. So the S&P 500 just blasted through. Didn't have a care in the world that we were hitting a double top here. So on the highs again, new all-time highs, looking strong. So S&P 500, just as I've been saying, wants to go higher. Path of least resistance is higher. Resistance had some resistance here over the prior week or two, but this past week, strong move. So looking good there. Let's take a look at the Nasdaq, which has been the strongest of the three main indexes. Also, all-time new highs this week. Every day was an up day this week. Nasdaq just hugging this 20-day moving average line. I do feel that the market is getting a little toppy here, a little frothy here. We're starting to see the market moves a little bit vertical. And by that, I mean it's just going straight up. And the trajectory is becoming more and more of a vertical line. And gravity at some point will have to take over, and the market will have a pullback. Doesn't mean we're going to be starting a new down move or a new bear market. It just means in order to have a healthy market, you have to have pullbacks from time to time because the market's getting ahead of itself. It's getting overheated. So what we want to see is when markets move up like this, we either see the moving average catch up to it while the market kind of takes a breather, or the market comes down to catch up to the moving averages. So what I foresee over the next week possibly is that the market will have a little bit of a breather. We've made these all-time new highs again, and let's take a little break here. Give some other people an opportunity to jump in. So I can see the market slowing down a little and the 20-day moving average moving up to meet it. So we'll get these moves like this where it comes down to the 20-day moving average, comes down to the 20-day moving average, comes down to the 20-day moving average, and then it could resume its uptrend. So we will probably see some version of the 20-day moving average up and the market price moving down to come meet with each other, and then most likely the market will continue on with its move higher. Let's take a look at the Dow Jones Industrials. Moving strong, just like I said, it wants to take out the all-time new highs. Not there yet, but it's certainly making its way. Every day this week was an update just as well. And in the last 2 weeks of videos, we talked about this bull flag right here. We have the flag, which is this move here, this little section of the move is the flagpole, the up vertical flagpole. And then we have the pennant, which is this little section here. What I want to do is draw this out a little bit more so everyone can see what I'm talking about. So we have the flagpole here. So we have this line. Let's make it a little bit wider so we can see what it looks like. Okay, so we have the flagpole there, and then we have the pennant, which is this section here. We'll make that a little bit wider as well so everyone can see what I'm talking about. And let's widen this one out too. Okay, so now what we have here is what is called the bull flag. You got the flagpole and the pennant, and I've been talking about this the last 2 weeks. Typically, a bull flag is you've got the move up, you got a little bit of the pennant downwards, and then it will eventually blast out to the upside from the direction in which it came, which is upward. So the Dow made the bull flag, rallied out of it every day this week. So it's working. Its next plan of action is to close this gap right here. We talked about gaps a couple weeks ago. Whenever there's a major gap on a chart, the market likes to eventually fill those gaps. We had the island top here, talked about that a number of weeks ago. We have gaps on both sides, which eventually the market moves to fill in the gaps, meaning after the gaps are created, eventually the market will move in a direction to close those gaps. So here, this section here, close these gaps. Now we still have this big gap up here, hasn't officially closed yet. It's starting to close because we got the market movement here. So it's inside of the gap here. Once we reach the bottom of this bar right here, the low on this day was about 28,892. And so the Dow has to go a little bit higher to officially close this gap, which I don't see any reason why it won't, probably in the next week. So the market looks strong, wants to keep going up. So we've got the Dow looking strong. We've got the Nasdaq just powering higher. Probably we'll see a little bit of a slowdown in the Nasdaq. I mean, that's just been the strongest of the three indexes. And the S&P 500 making new all-time highs, just blasting through resistance. So the path of least resistance is still higher. What are some catalysts that could slow it down? Of course, there's the coronavirus still here around the world, especially in the U.S. I believe the cases of infection have been slowing down. Death rate has been slowing down a little bit as well, which is a good thing. Still having hot spots creep up here and there in certain U.S. states. But the virus, I should say, the vaccines are coming on strong and hard. Lots of companies vying to create the vaccines. Got some good news this week out, more rapid testing. Abbott Labs has created some kind of new fast testing test that that helped. So we got good news on the vaccine front, and the market is liking what they're hearing. The Federal Reserve in the U.S. had their meeting this week, or we had the notes that came out from their prior meeting, and they're going to keep interest rates low for a very long period of time. So the U.S. government, the Federal Reserve of the U.S. is doing everything they can to help keep things afloat, keep the financial system liquid, money moving around. So the only place you're going to get a return on your money is in the stock market. So that's just fueling these rallies here. And are the stock valuations worth it at these high prices? Some say it is. That's the market going up. But at the same time, it could be a little artificial because everyone wants a return on their money. So everyone's just buying stocks no matter the price of the stock. So, I think we're getting a little frothy here. It would be good to have a little bit of a pullback. That's healthy for the market. But otherwise, the path of least resistance is still higher. So if you have your position, stay long. Don't forget to set your stop losses, because if the market turns on a dime, you want to be able to get out and lock in those gains. So look for the market to remain strong, maybe have a little bit of a pullback this week, but path of least resistance is higher. So let's take a few individual stocks, see what happened this week. Of note, Microsoft and Walmart the other day. We're talking about a collaboration to purchase TikTok, which is another social media app used around the world. I'm really not sure the reason why both Microsoft and Walmart would want to buy TikTok. What it could do for their bottom line, I'm not really sure. I guess maybe the advertising that comes along with it. But if you watch both Microsoft and Walmart yesterday or on Thursday, you will see the big move up in both of those stocks. This is Microsoft. So on Thursday, it had this big move up, moved up almost $10 a share. This bar right here is 1 day's worth of trading. So this is Microsoft. And we'll take a look at Walmart too. Walmart, look at that. Nice move on Thursday, just powered higher. That was a big move. It had been languishing around the 130 level, popped up, popped down, popped up, popped down, had some support around 130, then all of a sudden on Thursday, boom. Now it's above $140 a share. So Walmart has this nice uptrending chart here. So congratulations to those of you who are long Walmart. Let's see what else the market has done. Certain stocks, of course, we know Tesla. We like to look at Tesla these days because it's just gone parabolic. Tesla just still powering higher, making all-time highs. Tesla will be trading post split on Monday, and they're doing a 5-for-1 split. So prices will come down here, not because you're losing any money if you long the stock. It's just the stock is being split, and prices will be reflected on Monday. The same thing with Apple. They will be trading post-split on Monday as well. Apple finished around $500 a share, a little under $500 a share yesterday, Friday. So come Monday, the shares will be trading at around $125 a share. So that is some good things. So we also want to look at some price patterns here. This could also be looked at sort of like a bull flag as well. This is more of a, you got the pole here, but this is more of a triangle shape, which also could be seen. It's a consolidation move, okay? So it's a little bit of a triangle pattern, which eventually should blast back up to the upside, and moving in the same direction from where it came. So it's made the move up, it's consolidating, it's coiling, it's storing up all that energy ready for the next power move, and most likely that move will be higher. So when we open up on Monday at $125 a share post-split, we'll see this. The pattern should still be there, and the next move for Apple should be higher as well. Now, I do want to bring up another chart just to show you some things that I've been looking at. This is a chart of Clorox. We may have looked at this in the past. Some people ask me, Lee, how do you tell when a stock has changed direction or that the momentum has shifted and I should be looking to get out or setting stops? You know, what do I do? So this is a perfect example. This is Clorox, and Clorox had been, look at this beautiful uptrending channel here. It didn't really have much effect from the coronavirus because Clorox products, wipes, everyone was just buying wipes. You know, you couldn't find them anywhere for a while, and the products they were making was just, everyone needed products made by company Clorox, and Clorox has just been a massive move higher. Look at this. This perfect uptrending channel. Had been the 20-day moving average, which is the blue line, and this red line, it was the 50-day moving average. So it was working along those. Both those moving averages were sloping upwards, which is something we like to see. We got the 200-day moving average still sloping upwards as well. But this is a perfect example of a stock all now making a move outside of the channel. And you want to potentially look for this possibly could continue to move down now. The 20-day moving average is starting to curl down, okay? And the 50-day moving average also starting to curl a little bit here. Once this 20-day, if this 20-day moving average crosses below the 50-day moving average, that is a really telling indicator that Clorox may have finished its upward move. And it's already fallen out of the channel. Okay, you can see the price action right here. These are the price bars, has come out of the uptrending channel, has fallen below both the 20-day and 50-day moving averages. So Clorox is a stock that you might want to keep an eye on if you're long, or set your stops, because there could be some continuation down. Don't know how much further down it goes. We've got the 200-day moving average, which is moving upwards. So keep an eye on Clorox. So this is a pattern that you can look at to tell you, what happens when a price moves out of its uptrending channel momentum and it's moved out of it. So I would keep an eye on Clorox if you're long. You may want to take some profits because you've had a great move here. So that's it on the front for what's happened in the last week in May. What happened going forward. So let's move on to our options education for the day. So today we're going to be talking about selling cash secured put options versus selling naked put options. What's the difference? What's the deal with the margin requirement, and how does the money work when you sell either a cash secured or a naked put option? Now let's bring up my little document here. Now, as we've talked about in the past, and what we do at Smart Option Seller is that we sell put options, we sell naked put options, and we sell put option credit spreads. When you sell a put option, obviously what you're doing is you're contracting yourself out to potentially buy a stock in the future at a price lower than its current stock price, right? So if a stock's at 100 and you want to potentially buy that stock at $80 per share at some time in the future, what you can do is you sell a put option at an $80 strike price, and what you're doing is you're contracting yourself out to potentially buy shares of that stock for $80 a share. It's currently trading at 100, so you don't know if you're going to be able to buy them at $80 a share. The only way that would happen is if the stock fell from 100 down to 80, and then you would be called upon to buy your shares at $80 a share. And in return for that obligation, you are paid an upfront premium. That's what happens when you sell options. You are paid by the option buyer. So in this case of selling put options, you're always paid by the put option buyer for your obligation to potentially buy that stock sometime in the future at a price of your choosing. Now, there's a difference. You can sell put options in two different ways. You can either do it as a cash secured transaction or by using a margin requirement. So what's the difference, and how does the money work in those two different scenarios? So my little cheat sheet here. Cash secured put, when you sell a cash secured put, like I said, you're obligating yourself to buy at least 100 shares of that particular stock sometime in the future. And eventually you may have to buy that stock, and you'll have to pay for that stock in full at some time in the future. Now, when you sell the put option, if you sell a cash secured put option, that means that you have to have all of that money ready to go to buy the 100 shares in your account at all times, right? So even though you don't know whether you're actually going to buy the shares of stock or not, you still have to have the full amount of the cost of buying those shares in your account at all times. That's called having a cash secured selling a put option. That means the cash is there ready to go. It's secured by money in your account. On the other hand, when you sell a naked put option in a margin account, you do not need to have the full 100% of the cost in your account at all times. You have what's called a margin requirement that's issued by your broker. And what the margin requirement is that your broker says, okay, instead of having the 100% ready to go at all times in your account, we only need to see somewhere between 10% and 20% of that full value in your account at all times. So this is in my opinion, a more efficient way to use your cash in your account, because when you sell that put option, you don't know if you're going to buy the stock or not in the future. So why would you have to have the full amount of the funds ready to go at all times? It's not really an efficient use of your money. So by using having a margin requirement, you will only need about 10 to 20% of that full value in your account on hold. And you can use the other 80 to 90% of your cash to trade other things. And so if in fact you do need to buy the stock down the road, you will have to come up, or at least the other 80 to 90% of that cash will be needed in your account at that time. So in the meantime, you only need about 10 to 20%, and then down the road, if it looks like you'll have to buy the stock, then you'll have to make sure you have the other 80 to 90% in cash ready to go. So I just want to clarify a few things here. If you're not familiar, the margin requirement is not the same thing as the term trading on margin. When you trade on margin in your brokerage account, that means you are borrowing money from your broker to buy stocks. That is not what you're doing when you're selling options. When you sell options, you have the margin requirement, which uses funds that are already in your account. When you trade on margin, when you want to buy a stock, you put up 50%, your broker puts up 50%, and you pay your broker interest on that money that they're lending you. That is not what we're doing when we sell options. So I just want to make sure you're square with the difference there. Now, if you have an IRA account and you are selling put options in an IRA, or you're selling put options in a cash account, you have to have the full 100% of the cash ready to go at all times. So if you're trading or if you're selling put options in an IRA account, you have to, by law, have the 100% funds ready to go at all times. So, selling put options in an IRA, that's up to you. Sell put options in a margin account, a regular margin brokerage account, you will be able to have the margin requirement. So how does that work? Well, let's take a look at an example of what the money would look like if you happen to sell a put option. We're using an example of selling an IBM put option. So our example here is you're selling one IBM, one contract of the $105 put option for 57 cents per contract. Now, how do you figure out what margin is needed if you're trading in a margin account, or if you're in a cash secured account, how much money will you need to be held aside? It's very simple mathematics. All you have to do is take the strike price, which is the 105, and multiply it by 100, because there's 100 shares in each option contract. So $105 is the strike price, multiply that by 100. $10,500 would be the cost to buy the 100 shares of IBM at 105 per share, $10,500. So in a cash secured account or an IRA account, you would have to keep $10,500 on hand at all times in order to sell that put option. And if you're called to follow through with your obligation down the road, your $10,500 will be there ready to go. Now, in a margin account, where brokers typically will ask you to keep on hand 10% to 20% of that full value, here's how that calculation works. You take the $10,500, multiply it by 10% is $1,050, or $10,500 multiplied by 20% is $2,100. So depending on your broker, each broker is a little different. You have to find out how much they'll be asking you to keep on hand for the margin requirement. So you're going to need either $1,050 or $2,100 on hand at all times in order to sell that put option. Now, that's a lot smaller than having to put up the full $10,500. So you'll have, $8,000 or $9,000 extra dollars in your account to use for other trades in the meantime. So that's really the difference. So if you're using the margin account and having a margin requirement, you only have to put up either $1,050 or $2,100 to sell that put option. Cash account, you'll need the full $10,500. Now, what would that look like if you're executing the trade in your brokerage account? So here's my simulated account in Interactive Brokers. Now, I've pulled up an IBM put option here. I've got IBM finished at $125 a share on Friday, $125.30. So we're looking at the October 105 put. Example only here. And the bid ask went out 52 cents at 62 cents on Friday. Now, if we wanted to sell that put option, let's take a look at what it would do to our account and the margin requirement. Now, I just wanted to show you the account value for this fake simulated account is $1,031,850. There's no positions in this account, just $1 million in cash. So I want to show you what happens when you sell this put option, how you get the money, and how the margin requirement works. So we invoke the trade by clicking on the bid price, and it'll bring up a trade window in order for us to sell that put option. And we're going to want to sell it right in between the bid and ask price, which would be about 57 cents a contract. Now, in order to see how the money works, you click on preview here, and what it'll do is bring up a window, and it'll show you. Now, before the trade, we have $1,031,850 in the account. And after the trade, since we're selling the put option, we're going to get roughly $57 deposited into our account because we're selling that put option, we're taking the money. So post-trade, you can see the value of the account went up by about $54. So I guess taking into consideration commissions, so the account will grow. It's called equity with loan. This is the value of the account will grow by about $54. So you sell one put option contract, you're going to collect $57 by selling it, taking the commissions and all. Now your account will have risen in value by about $54. Here, the next line, the initial margin. So this is what the margin requirement is for selling this one option contract in Interactive Brokers. It's about $1,104. So it's just a little bit more than 10% margin requirements, maybe about 11% or so. So selling one put option contract, initial margin is $1,100. So that's what Interactive Brokers is requiring you, or me in this case, in the simulated account. It's saying that you have to have $1,100 of your $1 million account held aside in order to sell one put option contract. If you're going to sell 10 contracts, you just multiply this by 10, so that'd be about $11,000 you would need to hold aside to sell those put option contracts. So that's just one way of looking at the trade. You're going to get money deposited in your account by selling it, and here's what the margin requirement is. Each broker is a little different. We're going to dismiss this. We're not making this trade. So each broker is different in terms of their margin requirement. I know today most brokers fall in between that 10% to 20% level for the margin requirement. So there you go. There you have it. That's how trading works in a cash or a margin account. So it's up to you how you want to do it. Some people like to know how much money they're going to need in their account at all times if they're required to buy the stock at that time. Now, let's just look at the chart real quick. IBM, now this is example only. IBM is meandering around $125. The put option contract that you're selling is 105 strikes, so it's all the way down here. So you have a nice cushion here. IBM would have to actually fall down to $105 by October in order for you to be called upon to fulfill your obligation. So you have some cushion here. IBM's just kind of been meandering around. So, that's what we look for when we sell put options. We look to sell put options at prices way down here, strike prices way down here. So we have a buffer, got a cushion. And so that's it. That's your lesson for today on the difference between cash secured and selling naked put options. Once again, I always like to show you, if you go to our website, smartoptionseller.com, if you download our free put selling basics guide, we talk about margin in that guide, so you get a little bit more information about it. So download your free put selling basics guide. Just have to put in your name and email address. You could do it on the home page, or you can go to the put selling basics page. And lastly, of course, our services page. We got our newsletter, Smart Option Seller, Vertical Spread Trader. We sell put options, put option credit spreads, and our one-on-one coaching if you need help learning about option trading. So that's it for me today. Don't forget to like this YouTube video. Give me a thumbs up. Send me your questions. I will always answer. And I am wishing everyone a great weekend and a great trading week ahead. This is Lee Lowell signing off.